Hello, everyone, and welcome to the Hedge Fund Association webinar, Now and Next in Digital Assets. I'm Mitch Ackles, the president of the Hedge Fund Association. Just to give you a little bit of background about HFA, for those of you that don't know, the Hedge Fund Association is a global nonprofit trade organization and nonpartisan lobbying group. Our mission is to get people together to do business throughout the alternative investment industry, including hedge funds, private equity, venture capital, and many of our members are on the allocator side, including wealth managers, institutional investors, and family offices. If you're not already an HFA member, we will send you information after the event so that you'll be able to learn more about us and consider joining. So before we begin the program, I want to give a special shout out to the sponsor for today's webinar, Seward Kissel. It's a wonderful organization that you guys should be familiar with. Seward Kissel launched the very first hedge fund more than 100 years ago. They also are quite active in the alternative investment space and in the digital asset space. So I want to thank them in particular for making this event possible. I'd also like to thank HFA's annual sponsors, UMB Fund Services and Citrin Cooperman. We call them thought leaders, and their support of our organization makes many of the programs that we do throughout the year possible. So thank you to our sponsors today. I'm going to start off by introducing briefly our panelists. You will all receive the slide presentation after this event, which has full biographies for each of our panelists. But I'm going to give you a quick snapshot of who they are, and then we will kick it off. So first up is Christine Sandler. She's the head of sales and marketing at Fidelity Digital Assets. Thank you very much for Christine for joining us. Next is James Koutoulas. He's the CEO, of Typhon Capital Management. He's a global board member, the chair of our Digital Assets Committee, a member of our regulatory committee, and I believe also a hell of a dancer. James Koutoulas, thank you very much for joining us. And Anthony Tu-Sekine is a partner and the head of the blockchain and cryptocurrency group at today's sponsor, Seward Kissel. So thank you very much to all of our panelists. Thank you for joining us today. We look forward to an exciting program. And just some housekeeping for our panel and for our attendees. You want to go ahead and mute your phones. If you are an attendee, you're going to notice in your GoToWebinar box the ability to submit questions. So feel free to put any questions into that box. If we're able to address it during the course of the program, we will. Otherwise, we will certainly follow up with you after the program. But I want to again thank everyone for attending today. So now let's get started. So Christine, you are first up, and you have a very interesting background, and I think everyone can read your biography and Google you to know sort of the credibility you have within the digital assets and financial industry. But now you're with Fidelity, and I know that you've probably been with Fidelity since at least 2019. And I'd love to hear a little bit more about what Fidelity does in the realm of digital assets, what sort of services and solutions you guys offer. If you could please take it away, Christine.
Yeah, happy to. Thanks for having me, Mitch, and thanks to HFA for the event. And Anthony, thank you to you and Seward and Kissel for sponsoring the event. So at Fidelity Digital Assets, we're focused on Bitcoin. We are a Bitcoin custodian as well as an execution services platform for Bitcoin only. We focus on the traditional institutions that are entering the space. So when we think about kind of how we stack up with other participants in the space, we are very focused both in terms of the clients that we have on platform and in terms of the assets that we have on platform. When we think about what resonates about our platform with our clients, it's really our approach to risk, the safety and security of the treatment of the assets, and the integration between our execution services platform and our custody platform. So what we're deeply focused on is mitigating the frictions that traditional institutions have in kind of adopting digital asset strategies, beginning with Bitcoin. We anticipate that we will expand our product offering to include Ethereum later this year, but most likely, given the fact that we're really focused on kind of our client demand, we have not seen tremendous demand for really the long tail of altcoins among most of our existing client base. And when you think about kind of how Fidelity approaches the space, our clients are hedge funds, family offices, registered investment advisors, corporations, as well as banks, and practitioners in the space like mining firms and payment companies. And so that's what we're offering.
Fantastic. And obviously, just the sheer fact that Fidelity is in the space is an indicator for me. You guys were early entrants, and I think bringing you aboard, forming a team, an entire entity, Fidelity Digital Assets, to tackle it, that leads me to believe that institutionalization is underway, and that the types of clients you just described are more the traditional Wall Street alternative investment type firms versus the individual. So I see you guys seeing that opportunity and capitalizing on it.
That's correct. I would say that 2020 was pretty much a breakout year for institutions in crypto. So I think we had been talking about it for a number of years that the thundering herd of institutions was coming. They all figured it out in 2020. So I think there were a number of factors that led to this, the enthusiasm around digital assets and Bitcoin specifically. Global macro conditions, clearly, reduction of kind of the career risk in adding Bitcoin to a portfolio, and then finally, the mitigation of concerns around regulatory ambiguity. And I would say those are the primary drivers.
Well, you're reading ahead, because I've got some questions about that down the line, Christine. So now I'd like to turn it over to James. James, obviously at Typhon, a multi-strategy fund and CTA, you now have a cryptocurrency fund, or at least one that partially focuses in that area. Can you tell us a little bit about it? What motivated that from your standpoint, James?
Yeah, I mean, we've had our Leonidas crypto fund since 2017. I think we were the first CFTC registered crypto fund. So, we've been doing it for a while. We've been trading it with partner capital since like 2012. But just philosophically, if you look at strategies that are designed to make money off of volatile, supply constrained commodities, which, something like energy is very competitive, right? Like our crypto PM, George Michalopoulos, was the senior most energy derivatives trader at Citadel in 2011, right? So if you got a guy like that who can beat, millenniums and jumps and, all the biggest participants in that space, you can use similar strategies to really be profitable in crypto, right? So I mean, as a measure of risk-adjusted return, we're running like a 6.2 Sortino on a 51-month track record in crypto. And look, we're not religious about it. Like, I'm not a fan of all of the people out there who just pump crypto and are like religious about it and are like hodl till you die. Like, come on, give me a break. Like, it's a very volatile asset class. You've had 7 drawdowns of 70% or more in Bitcoin. And, a lot of the other crypto funds out there, like, they've taken 90% drawdown because, they're essentially levered beta, or they've got altcoin exposure in there as well, which means you guys make 1,000% just to get back to even. And that's not what we're about, right? I mean, we've got an institutional client base mostly, and, we look at crypto as something that we can profit off of, volatility and having good risk management. So, we love the space. We're looking at custodians, right now. Christine, I wish you did have some more altcoins, because, you obviously are my first choice, but, the space is growing by leaps and bounds. I mean, I really do think the way to address it is to trade it. I mean, that there's massive amounts of both momentum, and mean reversion that make it suitable for quant strategies. And then now that CME has put out listed, increased the list of derivatives to include Ether futures and options on Bitcoin futures, that's opened up a lot of like relative value type strategies. ways where we can, profit from down moves too. So, since the options on futures have come out, I think that we've returned double what Bitcoin has on a percentage basis, and about 35% of that has come off of the downside, and that's with fixed risk option exposure. So, as the space becomes more sophisticated, it opens up, funds like ours to really benefit from all the volatility.
Great, thank you very much, James. So Anthony, again, thanks to you and Seward Kissel for sponsoring today's program. What can you tell us about SNK's blockchain and cryptocurrency group that you lead? I know you're DC based, but could you tell us what you intended with the group within SNK and how's it going?
Yeah, absolutely. And again, thanks for having us on this great panel. I want to start off by telling everybody that unlike James, I have no rhythm whatsoever. My wife has prohibited me from entering any dance floor if she's within, distance. So if you ever see me dance, just have pity on me. So,
You got it.
we've been in the space since for like about well we've been in the hedge fund space since 1946, but we entered the blockchain space in about 5 or 6 years ago, mostly because we were convinced that this blockchain and cryptocurrencies represent a new wave of technology. I think that would affect all of our clients, and I think we're finally becoming to see that the promise has become true. Again, like Christine said, 2020 was a very interesting year. Early on, back in the 2015, 16, 17, a lot of the people who were entering the space and running funds, etc., really did not come from the fund space. They were what I call the blockchain guys. That is, we had a number of 20-year-olds with no fund experience come to us, ask to put together a fund for them, and then once we would explain to them exactly what it entails to run an actual fund, they would leave and try to luck somewhere else. I remember we had one case. I did get a story around our water coolers. We had like this 18-year-old who called. We did not know he was 18-year-old at the time. We wanted to have a $40 million valuation based on whatever he decided that was the right number. And then when we asked some questions about due diligence to onboard him, it turned out that he was not quite 18-year-old, was still a high school student, and we needed permission. He needed permission from his parents to enter agreement. So that is no longer so, right? In 2020, late 19, and now in 2020 and 2021. We've seen a lot of what I call our traditional hedge fund clients enter the space with pursuing, more or less traditional strategies. As James just pointed out, the fact that there are now, futures and options available on the two biggest cryptocurrencies by market cap and liquidity. There's a lot of different strategies that people can engage in. And so, we see, a lot more of our what I call mainstream clients into the space. The Bitcoin guys, so to speak, or the cryptocurrency guys that that have less fund experience and come more from the crypto side, or the people that are looking to do true DeFi funds, that is funds that invest in liquidity pools and have all kinds of strategies in the DeFi space. But I think that's really now for us a much smaller part of our clientele.
Great. Well, thank you very much.
I got to make one comment. I started trading when I was 15. Okay, I'm still here as an old man. So, the youngsters might need to learn all of this, but it doesn't necessarily mean they don't know what they're doing.
No, obviously not. I just, but it's like, I have normally the rest of our traditional hedge fund guys that come in the door, or venture capital funds or alternative strategies, none of them is like an 18-year-old high school student. There was just like a special kind of thing that was in the blockchain space that I think was really unique about this.
Anthony, your story reminded me of like the go-go days of the internet. Some of us actually remember that, where you'd meet someone either at a conference and they'd say, "Oh, I used to be a dentist. Now I'm a hedge fund." Yeah, so it was incredible. So you take your day trading strategy and you become a hedge fund. Not so easy. Not
Yeah.
so easy.
It isn't, but we also have to look at it from the standpoint of this generation is working with a different lens than what we had. And I think those of us that remember sort of pets.com and, everybody was a genius. And you're right about the sort of day trading 1990, late 90s. I think it was like 99 to 2000 that it was just nuts. And I think we are in a different era. But it's quite interesting to hear Anthony having people approach Seward and Kissel of all law firms to assist them with something in the space, and that person being young. And James, I would at least want them to have a driver's license, at least.
I think that, well, that's fair, right? Because if you're anything in crypto, you got to have a Lambo. So how do you have a Lambo if you can't drive it? And I think Seward Kissel, they just might be the Lambos of crypto law.
Yeah.
I will talk to their marketing department afterwards. So now we're going to dive in, and I'd really like to start with Christine with this question. And it's really a big picture question that I'd love for all of the panelists to comment on. Obviously, I mentioned that some of us within the Hedge Fund Association are lobbyists within the US. We submit comment letters about regulations. We advocate on behalf of our members. We're not averse to regulation. We just don't want it to impede job creation and capital formation. We want to make sure that new funds and new firms are able to launch and thrive, but we definitely want bad actors to be weeded out. But now we have a new administration. We have some new sheriffs in town. And I'm wondering, starting with you, Christine, what are some of the rules that govern digital assets, in particular in the US, that are on your radar?
Oh, for sure. This is a great question. Now, I think all of us kind of are looking at the seat change optimistically, given the fact that the folks that have been identified to take on leadership roles in the various agencies really do have some pretty deep digital asset experience. And let's take a look at Gensler. And Gensler's comments over the past couple of last week were really very, very telling. And I do think that there will be constructive regulation across the different agencies around digital assets. And what I think is important to many folks in the industry is greater clarity around the custody rule. And I think that can kind of be sharpened up for the benefit of lots of different regulated funds, whether they're 40 Act funds or regulated advisors. I do think that there's a lot of room where we can kind of sharpen up kind of some of the rules around the custody rule. I also think he brought up a couple of other key pieces, which really talk a little bit about kind of the nascency of the infrastructure. So we have a really, we have an infrastructure that's growing. We're starting to see this, as James pointed out, a really nice trend in terms of derivative exposure. But many of the exchanges that trade spot Bitcoin are pretty lightly regulated, if not regulated at all. And I do think that he mentioned that he'd like to see a stronger regulatory construct around cryptocurrency exchanges, which puts investor protection kind of at the forefront. So we embrace that. We look forward to kind of that direction kind of taking hold with respect to the US. But what we identify as kind of a concern is that regulation should not come at the expense of innovation. So clearly, we do have, a growing and robust crypto markets in the U.S. We'd like to maintain or grow those markets and not lose step with other jurisdictions based on not constructive regulation. So really, what we hope is that our engagement with the various regulatory agencies will continue to be constructive, fulsome across the gamut, so that we can create co-create rules that matter and rules that are impactful and keep that the core principles of innovation, but investor protection at the center of it.
Very good, and I couldn't agree with you more. I think one of the reasons, or one of the ways that people in our industry, or key influencers or organizations like Fidelity, Seward and Kissel, Typhon, and the Hedge Fund Association, we have to be part of the process in order to make sure that regulation doesn't overshoot the mark. it doesn't impede that innovation, which everyone is, seeing as possible. And from the U.S. standpoint, we need to compete in the globe, right? We need to make sure that those businesses are drawn to create their businesses and opportunities here. And so I think that there is an opportunity for us to be part of that conversation. And thank you, Christine. Anthony, next to you, before we go to James, what are your views as to what we might expect with the new administration?
Yeah, thank you. I echo everything that Christina said. I think, on the forefront, I think will be regulation for cryptocurrency exchanges. There's also a couple of existing rule proposals that have been held over from the prior administration. One big one is a FinCEN's proposed rule that would restrict traffic with self-hosted wallets. For those who are not familiar with that, if you have an account at Coinbase or Gemini or Fidelity or another regulated institution, then that institution will do KYC on you. Somebody will do AML and OFAC checks. But in the cryptocurrency world, it's quite possible to hold your own wallet and self-hosted wallet, so to speak. And there, you just don't know who's on the other side of it, because all you really know is the digital number address of the particular wallet. And so FinCEN came up with a rule that said, it is, a money services business, which includes just about anybody regulated in the United States that deals with money. A money services business is not permitted to send a cryptocurrency to a self-hosted wallet unless the name and address of the wallet holder is known. Well, that makes a lot of sense from an AML KYC perspective, but sometimes this has unintended consequences. For instance, ransomware payments, for those people who do get hacked and have to make ransomware payments, those payments have to be made to an unhosted wallet, right? And very few cryptocurrency criminals, will receive the ill-gotten gains on an exchange held by Gemini, right? So, and so while that regulation makes a lot of sense from an AML perspective, it may be really difficult for U.S. persons then to make ransomware payments, right? The other thing is that we have to be careful with regulation, because I see this in the CFTC world. Really the best cryptocurrency derivatives are traded outside the United States, and those exchanges, some of them offer like incredibly wild products. There's like a 4-hour Bitcoin future that perpetually rolls over, right? And as no U.S. CFTC regulated, a trader can offer that. And so we see our clients trying to figure out a way so they can access that. And that means that the regulated U.S. exchanges are suffering from that, because traffic goes away to some of the exchanges offshore. So that's we have to be careful that, as you said, we don't stifle our own commerce by trying to put in protections for retail investors.
Thank you very much, Anthony. So James, in your career, you have always fought for the investor. You've always illuminated the bad actors and done some pretty substantial things in that space. So I'm definitely curious as to what your views are with respect to regulation, and also whether it can be done in a way in which, those people are prevented from entering the space or dealt with. So what do you think, James?
Yeah, I mean, it's a real problem in crypto, to be honest. I mean, you have these set of technologies that are geared towards this, utopia of trustless authentication, decentralized authentication, but in large part due to a lack of a regulatory pathway to issue SEC compliant security tokens, at least to non-accredited. There is a pathway for doing accredited, but it's tricky. There's several limitations there. But because of there's no real way to issue a compliant token, a lot of the winners in the space have been those who have brazenly flouted the securities laws and done their offerings, right? So Right now I'm part of the lead counsel group in the Block.1 EOS class action where, they essentially committed fraud. They told people they were investing in a, revolutionary decentralized blockchain, and they were going to be owners of that. They were verbally telling people they were going to get 1,000% return on their investment. And really, at the end of the day, they put out non-compliant offering documents, didn't file any of the exemptions with the SEC, and then put in these ridiculous offering documents that people aren't actually investing in anything. What they're buying is worthless, and it's just going to be revenue of Block 1. And Block 1 went and bought 185,000 Bitcoin for their own benefit and made $9 billion and change off of the $4 billion that they, con people into giving them, right? And, these are backed by, several prominent hedge fund billionaires, like, some of the biggest names in the crypto space. So when you got offerings like that are, that's the biggest IPO of all time, right? 4 billion. And it was just a straight up fraud, right? So how do you trust a space that doesn't even self-regulate that? I've talked to some of the biggest victims of that fraud, and they refuse to put their names on the complaint despite having ERISA fiduciaries as clients, right? Because they don't want to lose out on order flow from the founders of Block 1. I mean, it's disgusting, and no one in the industry has stood up to stamp out the bad actors, right? And for the SEC's part, if you look at what they did in the Ethereum ruling, where they basically said, Ethereum probably was a security when it was released, but it then became sufficiently decentralized so that it's no longer a security. Like, I equate that from a precedent standpoint as like the underpants gnomes from South Park that basically had this business plan where it's like step 1 was collect underpants, step 3 was profit, and step 2 is a question mark. You could look it up on YouTube. It's quite a delightful little jingle, yeah. Right? But like, if you're the top regulator in the world, how do you go out there and say that basically you've got to create something that's sufficiently decentralized from day one in order to avoid being classified as a security? And DeFi is really kind of the response to to Ethereum, and remains to be seen what the SEC is going to do about it. I mean, they've made some noise that they don't necessarily like that, but it's like, look, if you want people to follow the rules, you have to put rules that can actually be complied with, right? Like, there's no Bitcoin ETF, but people can buy lottery tickets, right? People can buy, Bitcoin on their phone, right? With various apps. So
we need clarity, and we need, obviously, in order for you to be able to drive on the road, you need the rules of the road. So I wanted to, and I want to open up this question a little wider and ask Christine and Anthony and James to comment again. There's a situation with GameStop and Roaring Kitty and message boards and Elon on Saturday Night Live. What are the rules associated with people promoting investments in crypto? You've got Snoop Dogg and others that are sort of out there, and they've got spokespeople now at a level that we never saw in the hedge fund land. So what are some of those rules? And again, with all those situations on GameStop, it wasn't just individuals, even though it's been framed as sort of a David versus Goliath. But Christine, what are your thoughts on that situation? And
look, I think great, and James, great analogy with the underpants gnomes. I frequently refer to the underpants gnomes missing their business strategy. Yeah, all the time. Business strategy missing. Yeah, because it's really, I think profit is always the end game, but the messy stuff in the middle is usually a little trickier. From an investment perspective, Mitch, I think this is it's concerning. But like, quite honestly, I think from our perspective, I think we find kind of some of we as investment professionals and that have committed to digital assets find some of the Dogecoin nonsense a little crazy, and quite frankly a little disturbing. there's no shortcut for doing your investment work. So at the end of the day, anyone that's investing in digital assets should really be aware of the risks, whether it's the operational risks of holding those assets, or the risks of potential loss. This is an emerging asset class, a diverse emerging asset class with lots of different use cases. There's no homogeny among these assets. They are very different. And I think that the work that you should do is one that matches your own risk profile. When we think about, recommending a digital asset, that's a pretty big step. Just because Snoop Dogg made money in digital assets doesn't mean, or NFTs, it doesn't mean that these vehicles should be made widely available to the general public. So there's no shortcut for kind of doing the work, and that and there's no excuse. All of it is open source. Like, quite honestly, that's the key piece. The key piece is you can find this information with a browser. Like, so it is absolutely on, the obligation is absolutely on the investor.
Right, so the investor still needs to do the work. Anthony, is Seward Kissel going to have a celebrity endorser come out and promote anything that you guys do? I'm happy to make some phone calls. No, but
Well,
could you?
yeah, I was thinking about talking to James after this. I think we could probably use him. I would love to have my own Lambo. Christine is absolutely right. I mean, there's a lot of stuff in this area that is just incredibly crazy. Back in late 2018, I was trying to educate my kids about what blockchain and cryptocurrencies are like. So we spent $8.99 on eBay for a 1-hour mining contract, which got us 1,000 Dogecoins. And that's worth, like, 100-fold of what we spent back then. It's just, there seems to be no rhyme or reason why this should be so. So this is definitely a question of caveat emptor, right? I mean, you really have to be careful with what you do. I do disagree with Christine, though. I don't know if we need to protect the general public, because as James said, you're allowed to buy a lottery ticket, right? And the odds of winning on a lottery ticket are worse than on any cryptocurrency. Pick whichever one you want, I think. So I do believe that our retail investors need to be educated, but I don't necessarily want to create a situation where we say, we know what's better for you. You're allowed to go gamble in a casino, and you're allowed to do, buy lottery tickets, but you can't invest in cryptocurrencies, because that may end up driving, really just only the well-settled class to be able to really, profit from this.
It'd be back to the issue that the hedge fund industry has with accredited investors, and whether there could be an educational, designation. A professor might not have the net worth, but he might be teaching a class where clearly he knows how to do the analysis and understands what risks are in there. Yet someone that might be have inherited wealth could be qualified but not know what a Sharpe ratio is. So I think we've got a very interesting spot between the retail and sort of the institutional here. Okay, so we have a lot more to cover, so I'm going to keep talking. And one area that's quite of interest to me, and I think to the Hedge Fund Association, and I'm going to turn to you with this, Christine. You are one of the senior women in the digital asset space in the financial industry, and you've been quoted as saying that sort of Bitcoin is a message about financial empowerment and sort of self-sovereignty. And I think you think that this, that sort of crypto and Bitcoin can help close the gender investing gap. Can you comment on that? I read that, and I hope I didn't misquote you, but did I get the gist of it?
Yeah, the spirit of it is there. I mean, I think that when we think about the promise of Bitcoin and distributed asset technology, we think about this really incredible framework, and at the core of which is self-sovereignty and the ability for anyone that can connect to essentially connect to the network, anyone with a smartphone, to really kind of take some control of their their financial situation. So whether you're a U.S. investor or if you are in a country where you have an unstable sovereign currency, you have the opportunity to invest in digital assets. That's absolutely critical. What we do find is that it's dominated by men. We are starting to see a significant uptick in women investing in crypto. But what my appeal to women is if you want more choices and more flexibility and the opportunity to take on more risk in your life, whether you don't want to stay in a crappy job and you want, but you need the paycheck. The dynamic there about taking control of your investments should include an exploration of Bitcoin. And quite honestly, the key piece there is everything is open source. You can absolutely learn. There are plenty of people that are willing to teach you about the digital asset ecosystem, and the barriers to entry are very, very low. You can open any number of accounts, either Square, Cash App. Many brokers are beginning to think about incorporating digital offerings into their own more traditional footprints. There are so many opportunities for you to begin to dip your toe into the water and learn about this emerging asset class. There's almost no excuse. So I encourage women to kind of seek out those teachers, to do a little homework, understand what it's all about, and really dabble alongside the rest of us in this new asset class. I think they'll find the opportunities are really great, potentially from a financial perspective, but really more importantly from an educational perspective.
That's great. Thank you very much. And I hope that those of us that are men can be supportive of that effort and can offer those opportunities, and so that we also look at it from the framework as women are just as qualified to run the book as they are to do the IR. So it's not just the junior roles or the admin roles or any of those other ways that we have to look at it. They need to be empowered to be the managers. And I think we all have a role to play in helping that happen. Anthony, I think that obviously one of the things that I love about Seward & Kissel is that you guys are longtime members of the Hedge Fund Association. And some of your colleagues are senior supporters and leaders within the HFA, and I'm very proud to work with them. But I also know that the SNK is a member of the Wall Street Blockchain Alliance and the Digital Chamber of Commerce as well. What can you tell us about those organizations and what they do to advocate for the industry?
Yeah, thanks, Mitch. Both of those organizations are fantastic organizations, and both of them have, probably not surprisingly, the furtherance of the use of blockchain generally in as their remit. So the nice thing about the blockchain and the cryptocurrency environment, that it's still small enough that it has a really nice community. As Christine said, there is a lot of education available, and there's a lot of people who are more than willing to help, answer questions, etc. And both of those organizations kind of fall into that category. Both of them are cooperative organizations where we share ideas and exchange responses that we get from regulators, etc. And we, both of those organizations, actively work to try to influence the rulemaking process to make sure that the voices of the community are heard. Now, both of these two organizations are really industry organizations. That is, we all have a sharp industry bent. The members are actors in the blockchain space, custodians, law firms, etc. So they're not really retail oriented. But all of them have a great environment that really encourages people to help out. And I encourage people to explore things like that. And both of those organizations have enabled, Seward & Kissel attorneys, including me, to go and speak to, congressmen and senators directly in one-on-one situations where we can talk about the things that we think are important in the blockchain world. And I think that kind of access is really, in some respect, really priceless.
And I think if anyone's going to be in an industry or be part of it, if you can have a hand in the rules that govern it, it's smart, because you can ensure that they don't overshoot the mark and prevent, new businesses, new great ideas from having an opportunity to succeed. So just switching gears back to James. James, I know you've worked with investors for a lot of your career, most of your career, and you are an investor. Today, what are the investors asking you for with regards to blockchain? What are they looking for?
Well, so, I think there's a couple different, camps there, right? You've got, I think I guess segment investors, right? You've got like retail investors who, are essentially gambling with, I call it doggy coin because there's a dog on it, dog E. I don't say Doge, but stuff like that, and the altcoins, and really look at like the gamification of markets, since you've got trillions of dollars and brand new liquidity sloshing around. A lot of people there have made and will make a lot of money, and hopefully book it and not lose their house or anything over it, right? But so you've got that segment. You've got kind of the first wave of institutional investors that I think they were like, okay, well, we're going to get the highest vol crypto funds that we can, that are run by punters who blew up their global macro funds. There's several of those out there that have hundreds of millions of dollars in assets, and they're going to like allocate between 0.5% and 1% of their assets and say, okay, well, if Bitcoin goes to $1 million, I'm going to be rich. If Bitcoin goes to 0, I lose 0.5 to 1%. And I really have an asymmetric return profile with my limited liability fund investment, and this kind of highly levered, high octane vehicle. We really built our crypto fund for kind of the second wave of more sophisticated institutional investors that want to look at harnessing the volatility in the space in a non-religious way to make money off of volatility. So we're bullish on crypto, absolutely, but not in the levered beta like pump way. So I think heretofore you've seen a lot more people do kind of the retail gaming and the like levered beta like LP punting than you have kind of the risk managed approach. But we're not punters. That's just not how we roll. And then I guess kind of the last segment is the cross exchange crypto arbitrage, which for a lot of people that's been a very good trade. I mean, I think the edge has continued to kind of narrow there as you've had more entrants in the space. For us as a U.S. regulated fund, I don't really feel comfortable putting customer money on a lot of these Asian exchanges. We're U.S. exchange only. We do no OTC, only listed derivatives. So look, it depends on your risk profile. Like if you want to take 0.5 to 1% and punt in levered beta, do it. As long as you understand it. If you want to play with doggy coin, do it. I'm not a fan of the regulation that tells people when and what they can't do. I think that honestly, accreditation standards, are kind of silly. I'm much more a fan of having, shorter disclosure, disclose, what the fees are, what the strategy is going to be, what your, service providers and custodians are, and, let people do diligence and make their own decision, then, have hundreds of pages of disclosures, that no one reads, and, restrict people from coming into investments like this, but letting them go to casinos, like Anthony said, or, lottery tickets, or whatever. And, I'm a big believer in prosecuting a fraud, which that's the one thing that's been sorely lacking in the country, really, since the government lost the Bear Stearns case that came out of, when was that, 2007, I think, the Bear Stearns Alphas fraud. Jesse Eisinger has a good book on it, The Chicken Shit Club, about how the DOJ is basically, terrified of bringing fraud prosecutions. So, I'd like to see more of that and less regulation, personally.
Okay. All right. So just switching gears again, and this is back to the regulatory aspect. And obviously, one of the things, James, you mentioned this early on in your comments, and it's been something that I know S&K has been involved in, and we've all had on our radar, which is a Bitcoin ETF in the US and having it approved. I think we're seeing these things being approved in other geographies. What do you think, and I would start with Christine and then over to Anthony. What do you think, Christine, is the hurdle here? What is the SEC and the CFTC waiting for in your view, and what are your thoughts about the opportunity for a Bitcoin ETF?
Well, I think in the past, the ETF hopeful applications, the ETF applications were struck down because of a concern around a lack of market surveillance, and that's kind of across that cuts across kind of the infrastructure that we see in digital assets. So it's still highly fragmented. You do have kind of a fair amount of liquidity that trades in the dark, but you also are seeing a greater focus on market data standards, folks that are beginning to kind of stitch together the ecosystem, and counterparties that are accessing liquidity in kind of more traditional ways, so where it's a little bit similar to others. So you're starting to see that kind of an emerging standard. That being said, I do think that I think there are 9 applications, of which we are one of them, for a US ETF. I also think that the SEC may potentially look to other jurisdictions and see how these products, how these products are being used. I think it creates a great opportunity for us in the US to have a diversity around product. So where clients, for some reason or another, cannot hold either physical Bitcoin, they want something a little bit more structured. There are operational concerns or management concerns. This could potentially open up Bitcoin or digital asset access to lots of different investors for different reasons. We're really hopeful that this could be the year that the SEC actually takes action. How they will take action and what the approval process looks like is really anyone's guess. I think it could go in a couple of different ways, where there may be some kind of gamification around it, where they have 9 potentials. Will they appoint a kingmaker? So will they take one first? Is it first in, first out? What are some of the criteria that they are looking at with respect to the potential approval process? Will they approve all 9 at once? I'd ask, Anthony about kind of how he's thinking about advising clients that are in the queue. But we think that this could potentially be the year, and this could be really great. I mean, when you think about the approval of an ETF or potential ETF product, it opens up lots of different, even arbitrage opportunities. When you're thinking about expressing an interest in a single asset in different ways, this also creates an opportunity to implement other strategies, which is really key.
Great. Anthony, I think SNK has signed on to at least one comment letter that I saw. What can you add to that?
Yeah, we had one of those funds that was in the hopper, to try basically for 2 years in a process that I think is you probably best described as hitting your head against the wall. I think that one of the problems is that there is, as Christine said, there is significant distrust about price discovery amongst the staff. And one of the problems that I always try to explain to clients is that, look, if you look at a regulator's career, a regulator will not get rewarded for highlighting an ambitious new product that enters into a new area, right? So whoever greenlights the first Bitcoin ETF is not going to get, maybe just going to get a pat in the back, but that's about it. However, if you greenlight something that goes completely kaplooey, your career's in a toilet, because you'll be the one that has greenlighted that, right? So I think there is a significant amount of inertia from regulators who already said have a healthy amount of distrust about the cryptocurrency space. And they're not alone, right? I mean, if you talk to the people on the street, or heck, if I talk to my fellow partners, there is plenty of them who are still wondering why we're even bothering to touch this particular asset class, because they think it's all fraud, just all fraud, no redemption whatsoever, right? And so I think I think 2022 maybe a little bit too optimistic, Christine. I mean 2021. I think 2022 maybe the year. But you know, I keep going back and forth, right? And I'm hoping that you know, Canada now has quite a number of traded Bitcoin funds and Bitcoin ETFs. And so I'm hoping that you know, that example will help our regulators, who generally are very trustful of the Canadian regulators. So
Yeah, Anthony, you do make a really good point. The SEC's got a pretty tall list as well. Like they're looking into some pretty thorny issues that are non-digital related.
yeah, right.
They've got a little bit of a to-do list. Okay, so switching gears, and I know that we have about 8 minutes left, so I'm going to move through these quickly. And I'm going to start with Anthony. One more question for you. NFTs. So are you telling me that I could buy a picture of something, never own it, and sell it at auction and make money? I'm trying to get my arm around what these things are and what your thoughts are. And I know you guys were involved in, I believe, the largest one in terms of a sale. Could you speak to that as well?
Yeah, we represented Sotheby's in its sales of NFTs, which was the second largest one. The largest one was the Christie sale of the Beeple NFT. And you know, everything that we've said about cryptocurrency, I think, goes in square with you know, with NFTs. NFTs are an evolving area, and there's many different things about NFTs that you know that you know, people don't realize or are not thinking about. And the first one is exactly what is it that you get when you buy an NFT, right? There's a lot of confusion about this, right? So, you know, currently, usually what NFTs are, they are they're a non-fungible blockchain token that has internal data, metadata that will, you know, you can use to prove that you are the one that owns the rights or certain amount of rights to a particular digital artwork, right? And if you think that's difficult to comprehend, you know, that's you know, that's only the beginning, right? And some of these NFTs, you know, only give you the right to display it. Others give you the right to resell it. But if you do resell it, then there is a commission that the artist gets from the resale, etc. So it is a really a developing area. I think it's going to be, you know, very important in the digital artwork and digital music world going forward. But there's still a lot of stuff that needs to be shaped and formed until we are like there for like mass adoption.
Interesting. Okay, and James, to you for this sort of last question before I wrap it up with a final question for all of you. Decentralized finance, DeFi. Lots of these terms are coming around, but James, what is it? What is DeFi? Why does it matter?
I kind of alluded to it earlier. It's you know, it's essentially a way for people to try to cash in on the crypto you know, craze, but be consistent with the Ethereum you know, litigation, saying that we're starting decentralized by, you know, airdropping tokens or whatever, and just, you know, trying to get this critical decentralized math. You know, I'm not saying it's a total, you know, non-starter. There are some useful, you know, applications, you know, like you're seeing, like kind of yield farming funds are one kind of application that's coming out of DeFi. You know, we've traded a fair amount of Uniswap, and, you know, think that has, you know, some promise, but, you know, it's just a further leap down like the smart contract, you know, world, and, you know, trying to get the reconcile, like, you know, the promise of crypto and kind of like the ease of doing smart contracts in a perfect world, but reconciling that with kind of the lack of a pathway to just do a straightforward security token and existing regulations.
Okay. All right, and I'm going to turn this question starting with Christine. So, Christine, is there something I should have asked you that I did not ask you?
No, I think, but building on the last two questions, so the NFTs and DeFi, I think what's really important for us to look at, you know, are these both kind of proof of concepts that we can potentially, real-time proof of concepts that we can potentially leverage into work streams for the future? Even ICOs, as challenging as they are, it's a potentially elegant mechanism to raise funds for small and mid-cap organizations. And I do think that when we think about kind of the core of the technology and the intention of the use case, if we can wrap that in kind of a maybe appropriate governance, this creates a promise for the future, whether it's creating income streams for artists and producers, or decentralizing some of the core functionalities of financial intermediaries. These things are really empowering, and so I think that we shouldn't lose the forest for the trees. Even though there are some there are some questionable activities, at the heart there is some pretty amazing innovation that's occurring.
That seems to be a recurring theme throughout all of this conversation and just throughout all of this digital asset segment. There's a lot of opportunity. It's a matter of sort of the governance of it, the structure of it, how you execute it. And from, I think, our audience, the audience of the attendees here, but each of us as individuals, making it digestible to the institutional investor, making it acceptable to fit within their asset allocation, to fit within their risk profiles. Anthony, is there anything that I should have asked you aside from your great ability as a dancer that I didn't ask you?
I think an interesting question for me would be like, how will we experience blockchains 10 years from now? And I think, I always tell people cryptocurrencies are the tail that are wagging the dog right now. I think, as Christine said, blockchain has a lot of very interesting applications, decentralization. I think it has a lot of promise. I think we will be able to automate a lot of systems. I think it will streamline our industry, the financial services industry, very much like the internet has streamlined it before, right? So if you look at, for instance, you take the example of brokerage, right? There was brokerage before the internet and there's brokerage after the internet, but the way that brokers do business right now and the way they make money and the way that their clients act is completely different than it was before the internet, right? And I think blockchain is going to be very much like that.
That's quite interesting. James, to you to wrap it up, any final thoughts that you want to share with the audience? And before you do, I just want to let the people that submitted questions, that we've got those questions and we will circulate them to the right panelists and make sure that they can get back to you. Because obviously we could probably talk for another hour easily. But James, any thoughts that you want to share before we wrap up?
Yeah, I mean, just kind of to close the theme we've been dancing around a lot today, I think that, the SEC really needs to stop making perfect be the enemy of the good, because you really have just like a perverse incentive structure right now in that, like I get it, like there's ongoing Tether litigation that, alleges that, fraudulent tethers have possibly massively inflated the price of Bitcoin, right? So when that's ongoing, how do you approve a ETF? I mean, I think that's probably the number one reason that, they haven't, approved a Bitcoin ETF. But, when you look kind of the next step, well, people could buy it on their phone and like they're losing passwords, they're losing apps, they're getting hacked, right? So by saying that because we're concerned about Tether, look, have people disclose it. Be like, if they're willing to take the risk to buy Bitcoin on their phone or buy, they're going to doggy coin because they can't buy, Bitcoin, right? You're stifling people from doing something that they want to do anyway, right? And same thing with like security tokens, right? There I feel a big reason that security tokens have taken so long to get a proper framework is because it risks disintermediating the big banks who are, the biggest lobbyists, to the regulators, right? And, I was sitting 10 feet from my old adversary, Jamie Dimon, at the IMF annual meeting when he was like, Bitcoin's stupid, Bitcoin's a fraud, Bitcoin's for money laundering. And now, 3 years later, JP Morgan's making all these, announcements about all the different things that they're doing in crypto, right? So, I don't think it's quite right to slow down, the entire industry to give banks a chance to catch up, because, this was one of the first major financial products in history where they weren't first, right? Like technologists were first and retail were second, and, institutions and banks are distant third. So, I'm really a proponent of having a framework where non-accredited could go into security tokens and they could, buy a Bitcoin ETF and, let them make decisions with their money, because, God knows they're doing it now with scam coins and altcoins and, other non-investment things.
Thank you very much. Well, with that, obviously we could talk for longer, and so we're going to have to invite all of you guys back to do another follow-up HFA webinar on this topic, because I really think that this is early days. Each of you have, there's one thread that I've seen weaved in your comments, which is we don't want to stifle new opportunity with over-regulating, but we do need some rules, and we do need some frameworks, and we do need some evolution. And James made an exceptional point in that this didn't start with the banks or the institutions. This started with the retail and sort of the mainstream people. It's going to be quite interesting to see where we sit a year from now on this. So we'll hopefully make sure that we put another program together and bring you guys back. And maybe we'll do it in person, because I think we're on the edge of that being possible in the next few months. So I want to again thank our outstanding panel. I want to thank Seward and Kissel, and of course HFA's thought leaders, UMB Fund Services, and Citron Superman. And to all of our attendees, we will be following up with you with a recording, the presentation, and ways that you can get in touch with us. So thank you again, everyone. Have a great day.
Thanks, Mitch. Thanks, guys.
Thank you.